biggest financial lie in American history didn't look like a lie at all. It looked like innovation. It looked like genius. It looked like the future. A company worth $70 billion, trusted by Wall Street, praised by the media, and admired by politicians, collapsed almost overnight. And when it did, thousands of people didn't just lose money. They lost their life savings, their retirement, their future. But here's the part that makes this story different. The people who built that illusion, the executives who engineered it, didn't go down with the company. They walked away with millions. Because this wasn't just fraud. This was a system, a blueprint, a way to manufacture wealth out of thin air, sell it to the public, and disappear before reality catches up. The name was Enron. And if you think this is just a story from the past, you're already missing the point. Because the same tricks that built Enron are still being used today. To understand how something this massive could collapse so quickly, you have to go back to the beginning. In 1985, Kenneth Lay orchestrated a merger between Houston Natural Gas and Internorth, forming Enron Corporation. At first, it didn't look revolutionary. Just another pipeline company. But Lay wasn't interested in staying ordinary. He didn't want Enron to just move gas through pipes. He wanted it to become something far more powerful, a financial machine. A company that didn't just sell energy, but traded it like stocks and bonds. And the timing couldn't have been better. The late 1980s and 1990s were defined by deregulation. Governments were loosening control, breaking monopolies, and opening markets. In the energy sector, this meant natural gas and electricity could now be bought and sold in new competitive markets. Enron positioned itself at the center of this shift. By the 1990s, it wasn't just a pipeline company anymore. It was an energy trader, a market maker, a company that promised to bring financial sophistication to an industry that had never seen anything like it. Wall Street loved the story. Politicians praised it. The media couldn't stop talking about it. Enron became the symbol of modern capitalism. Fortune magazine named it America's most innovative company 6 years in a row. Its stock price soared. Investors piled in. At its peak, Enron became the 7th largest company in the United States. But the real story wasn't what Enron was building. It was how it was being built. Behind the success, behind the headlines, behind the image of innovation, there was nothing solid holding it together. The real genius of Enron wasn't creating markets. It was creating the illusion of profit. And the tool that made that possible was something called mark-to-market accounting. Normally, companies record revenue when they actually earn it. When a product is delivered. When a service is completed. When cash comes in. Enron didn't wait. The moment a deal was signed, it recorded the entire projected profit immediately, even if that profit wouldn't exist for years, or might never exist at all. Imagine signing a 20-year contract expected to generate $50 million. Enron would record that entire $50 million on day one. On paper, it looked like explosive growth. In reality, it was guesswork, dressed up as certainty. And once that illusion started, it had to be maintained. Because if future profits didn't match expectations, the whole system would collapse. So Enron doubled down. To hide the growing gap between reality and fiction, Enron needed somewhere to bury its losses. That's where Andrew Fastow came in. As Chief Financial Officer, Fastow created a network of special purpose entities, or SPEs. These were shell companies designed to take on Enron's debts. On paper, they were independent. In reality, they were controlled by Enron itself. The goal was simple. Move the debt off the balance sheet. Make the company look financially strong. Keep investors confident. It was financial illusion at a massive scale. A system built not just to mislead, but to survive. Because as long as the stock price kept rising, nobody wanted to ask questions. Inside the company, the culture made things worse. Jeffrey Skilling, who became CEO in 2001, pushed a brutal performance system known as rank and yank. Employees were constantly evaluated against each other. The bottom performers were fired every year. It didn't matter how hard you worked. If you weren't producing numbers that looked impressive, you were gone. That pressure created something dangerous. A culture where perception mattered more than reality. Where employees learned quickly that survival depended on making the numbers look good, no matter how they got there. Inflated deals. Exaggerated projections. Creative accounting. It all became normal. Because the system rewarded it. Even Enron's so-called innovations followed the same pattern. The company claimed it could create markets for anything. Broadband. Water. Weather derivatives. If it could be turned into a contract, Enron said it could trade it. But many of these ideas never worked in practice. The broadband platform failed. The Dabhol power plant in India became a multi-billion-dollar disaster. Weather derivatives looked impressive on paper but delivered little real value. And yet, profits were recorded immediately. Because the illusion had to continue. Always. For a while, it worked. Executives became wealthy beyond imagination. Kenneth Lay, Jeffrey Skilling, Andrew Fastow, they were seen as visionaries. They cashed out millions in stock while publicly promoting confidence. But beneath the surface, the cracks were growing. By 2001, questions started to emerge. Why were Enron's financial statements so complex? Why was it so difficult to understand how the company actually made money? Analysts began to dig deeper. Short sellers started betting against the company. And then, reality caught up. In October 2001, Enron reported a $618 million loss. For the first time, the numbers didn't look perfect. The illusion started to break. Soon after, regulators launched investigations. The hidden debts came into focus. The off-balance sheet entities were exposed. And suddenly, the profits that once seemed so real disappeared. Wall Street turned quickly. Confidence vanished. The stock price collapsed. And on December 2, 2001, Enron filed for bankruptcy. At the time, it was the largest bankruptcy in American history. The consequences were devastating. More than 20,000 employees lost their jobs. Many had invested their retirement savings in Enron stock, encouraged by the company itself. That stock, once worth over $90 a share, dropped to less than $1. Years of savings, gone. Entire futures erased in days. Families who trusted the system found themselves with nothing. Meanwhile, the executives who built the illusion had already secured their wealth. Kenneth Lay sold over $300 million in stock. Jeffrey Skilling cashed out more than $200 million. Andrew Fastow personally profited from the very structures that hid the truth. Some faced consequences later. Skilling served prison time. Fastow cooperated with authorities. Lay died before sentencing. But for most victims, justice didn't change the outcome. The damage was already done. The scandal didn't stop with Enron. Its auditor, Arthur Andersen, one of the most respected firms in the world, was exposed for its role. Documents were destroyed. Warnings were ignored. And within months, the firm itself collapsed. The fallout led to new regulations, including the Sarbanes-Oxley Act of 2002. Stricter rules. More oversight. Greater accountability. On paper, it looked like a solution. But the deeper problem remained. Because regulation doesn't change incentives. If deception is rewarded, it will continue. And that's why Enron still matters today. Because the pattern didn't end in 2001. In 2008, financial institutions packaged risky mortgages into complex securities. The risk was hidden. The profits were exaggerated. And when the system collapsed, it triggered a global financial crisis. In the 2020s, crypto platforms like FTX repeated the same story. Billions disappeared. Investors were misled. Insiders walked away with fortunes. Different industries. Different technology. Same playbook. And here's where it becomes personal. Because this isn't just about corporations. Your savings. Your investments. Your financial future. All of it exists inside systems that can reward illusion over reality. A rising stock price doesn't always mean real value. A popular company isn't always a stable one. And a confident executive isn't always telling the truth. Enron proved that numbers can lie. That success can be manufactured. And that trust can be exploited. The lesson is uncomfortable, but necessary. Real wealth isn't built on projections. It isn't built on hype. And it definitely isn't built on numbers that only exist on paper. Real wealth is something that lasts. Something you understand. Something you can rely on. Because in the end, illusions are profitable. But only for the people creating them. Enron wasn't just a failure. It was a warning. A preview of what happens when greed outpaces reality. And if you don't understand how these systems work, you risk becoming part of them, without even realizing it. Because history doesn't repeat exactly, but it always leaves clues. And Enron left one of the clearest warnings of all. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to look.